What about this mention here? Let's take a couple moments here, even though we're at 5:30 p.m. Eastern Time. In the money versus out of the money bulk call debits. The at or out of the money bulk call debits, let's go back to our search. Let's go back to our NVIDIA position, the initial one we were looking at in the profit and loss chart. And we were, of course, looking at the parity trade that came up with a negative. Now, high probability in the money debit spreads are great for shorter term, 14 days out, 30 days out in time even, getting that higher probability, looking to make a leveraged 10, 12, 15, 20% return. But a lot of investors don't like this. I mean, here's the bull put we were looking at. I had a gentleman call me up the other day as a trial member to PowerOptions, and he said, "You're familiar with expectancy of profit or profitability?" I said, "Yeah, I know the term. We just don't tend to use it here at PowerOptions." He says, "Well, I looked at your bull put credit spreads and your debit spreads, and your positions don't profit." I guess they do. I trade them myself. But he says, "No, you're looking for positions that 85% of the time you make 28 cents. So I do this multiplication here, and then 15% of the time you lose 250, or okay, in this case 222, 223, and those numbers don't add up. This one's higher, so you're always going to lose money." Oh, okay, yeah. But as you guys heard me talk before, we just don't go in, open the spread, leave it alone to expiration and be done with it. We're going to put in alerts to close these positions. We never allow a credit spread to go beyond 50% of the maximum risk on the trade, in which case, yes, with the success rate I have using the weekly bull puts in the right market conditions, where we're not seeing the bearish sell warnings in the market sentiment tool, we're right 85, 86, 87% of the time, average return about 14.9% on the winners, and average loss is 49%. And yeah, that more than meets my targets that I'm using for this strategy. But this does deter a lot of investors. Hey, I want a high probability trade, a high probability of success of 85 or 90%, but I don't like this 8-to-1, almost 10-to-1, 8-to-1 or 9-to-1 risk reward ratio I see. I want to have a ratio of 1-to-1 or 2-to-1 on my trades. Well, that by definition is only going to be a 40 to 50% probability of getting the max return. But a popular approach that came out several years ago, we have a default search in the sample searches view to show this, is the farther term at to out of the money bull call debit spread. And what I'll do in this case, now I won't advise this with the video because I'm pretty sure we're going to be crossing earnings between now and the time frame, but an example of the at or out of the money debit spread is I might go 90 to 100, 124 months or 5 months out in time. Let's just go to June. And we're going to keep with a 5-point spread in this example. What I might do in this case is I'm going to sell the just out of the money 595 call, 150 days out, maybe 90 days out, just at or out of the money. And I'm just going to buy slightly in the money at 585. We're going to get close to 68.85 here, and we're going to pay about $74 here. So that's going to give us a net debit of around $4 or so. Yeah, so at midpoint, it's a net debit of 515. I'm sorry, I did the 10-point spread. I said 5, I did the 10-point. I brain fart there. That's okay. What are we looking at here? Well, this is a debit. Let's just round this up to keep it simple. We'll just put this sell price at 80. And the buy price here, yeah, we'll put it at 95. Let's be fair. Okay, let's just do that. We won't get those prices, but at least it's a nice round number. There we go, same number. But look, here's the thing. We're going to sell this for $68.80, buy this for $73.95. We're going to have a net debit of $515 on a 10-point spread. We're right at the money. So come June expiration, the stock is trading above $595. Who knows, but speculation. I'm looking to make $485 profit on a $515 debit, or 94.2% return. I have closer to a 1-to-1 risk reward ratio, and I'm right at the money. but I'm further out in time. I think the popular approach, by the way, is 75 to 90 days out in time. This might be exceeding that, but that's okay. This is what gives you the one-to-one ratio. But now, what most investors who do this approach with the at or out of the money bull call debit spread only, to keep that one-to-one ratio, which makes them more comfortable, even though they know they only have about a 50% probability of making this max return, which only would be made in 150 days when all time values out of both options. What they look for is if NVIDIA went up to 610 or 615 sometime in between, they're going to look to close the position for half of the profit, $2.42, when they close it for the debit. So they're still making 47%, close to 50% profit on the position in that case, but they did it in the shorter term. They're not looking to necessarily hold it all the way out in time. Now, of course, if the stock falls initially, you're not going to be able to get that return. You're going to have to wait for it to recover. And even if it ends up in here, though, you might have to wait longer. You'd still have a good profit on the position. But that's approach which satisfies this desire of this one-to-one risk-reward ratio. That was what's discussed in that in the money versus out of the money debit spread on the bull call debit spread YouTube playlist for Power Options. I'm sorry, in the money versus out of the money spreads. Only do with a debit spread. Never do this with a bull put. Why? Because remember, early assignment can occur. Early assignment on in the money puts tends to happen more frequently than in the money call positions. So if I did this as a bull put credit, sold the 595 call right at the money 150 days out and bought the 585 put, might get a credit of around 480 or 485. It's going to be a parity trade. But if the stock falls and just drops down to 590 or 585 when I first open the trade, I'm running the risk of being assigned early on that 595 call. Did you want to buy 500 shares or 1,000 shares of NVIDIA at the 595 strike? Maybe you did, but most likely you didn't. So that's one of the reasons why you never do this style, this at or out of the money, farther out debit spread approach with the parity credit spread trade due to the risk of early assignment. But it can be done with a debit spread. It gets you closer to that one-to-one risk-reward ratio. And as I mentioned, of course, in bull call debit, if I go to sample searches, you have a default is 60 days or more at a time. Like I said, that 75, 60, 75 days out. Out of the money, out in time, bull call debit spreads. It's a theme search with set criteria, just like we saw in the search. 60 to 150 days out in time, looking for that higher return. Costco at 694, 119 days out, the May 695 and 690, net debit of 293 for a potential of a 71% return. But I'd look to close it early if I made 30, 35%, or half of the maximum return I expected, which would be, 293. So it'd be $2.07 maximum profit at expiration if Costco is above 695. So I get half of that somewhere in between. I might take that off the table. You see some of the more closer to one-to-one, the 96 or 100% returns. That's closer to that one-to-one risk-reward ratio. This one's weird. It's in there, but man, it's only a 20% return. But again, probability, as I mentioned, 50%, 49. You're not looking to hold it all the way to expiration to make the max return. You're looking to do it more as something where you can make half of that, maybe in a shorter term if the stock does what you want. Okay. But again, that comes down to also what makes you the most comfortable. Out of the money credit spreads with a high probability, in the money debit spreads with a high probability shorter term. You're still looking for that higher probability of 80, 85, 90%. You're still going to have an 8.5 to 1, 9 to 1 risk reward ratio. That's the nature of the trade and looking for the higher probability. But with a debit spread, another approach that's popular with different options educators, different investors use Power Options, is this out of the money debit spread farther out in time to get closer to that one-to-one risk reward ratio, returns in the 70, 90, 100, 80% range here, where your debit is closer to the difference in strike prices Lower probability of full success, but you're looking to maybe only take half of that off the table at some time during the trade if the stock meets your expectation. Bull in this case for the bull call debit, or bear for the bear put debit spread as well.